Picture this. You've worked your entire life, paid into Social Security for decades, and now there's a deadline looming that could cost you $2,400 if you miss it. January 1st isn't just another New Year's Day this year, it's a critical cutoff date that every Social Security recipient needs to understand right now. The Social Security Administration has implemented specific enrollment periods and deadline requirements that directly impact your benefit amounts. What most people don't realize is that certain decisions about your benefits must be made before the calendar flips to 2025, or you could face permanent reductions in your monthly payments. We're not talking about temporary holds or minor adjustments. This is about money that you've earned through years of hard work, money that could disappear from your retirement income if you don't take action. Here's what's really happening. There are strategic moves involving Medicare enrollment coordination, tax withholding, elections, and benefit calculation windows that all converge at year-end. Missing these deadlines doesn't just delay your benefits, it can reduce them permanently. Let me break down exactly what you need to do before December 31st to protect every dollar you're entitled to receive. Let me be completely transparent with you right from the start. The Social Security system is more complex than most people realize, and the rules change frequently enough that even folks who've been receiving benefits for years can miss critical updates. What we're dealing with here is a combination of enrollment deadlines, tax implications, and benefit optimization strategies that all come together at the end of the calendar year. And here's the thing that frustrates me the most. The Social Security Administration doesn't exactly go out of their way to make sure everyone understands these deadlines. They send out notices, sure, but those notices are often written in government language that would confuse a lawyer, let alone someone just trying to figure out how to maximize their retirement income. So let's talk about what's really at stake here. The $2,400 figure isn't just some random number pulled out of thin air. It represents the actual financial impact that missing certain year-end deadlines can have on your annual Social Security income. This can come from several different sources, and understanding each one is crucial to protecting your benefits. First, there's the Medicare premium issue that catches thousands of people off guard every single year. When you're enrolled in both Social Security and Medicare, your Medicare Part B premiums are automatically deducted from your Social Security check. Now, the standard Part B premium for 2025 is being adjusted. And if you're subject to the income-related monthly adjustment amount, commonly called IRMAA, your premiums could be significantly higher based on your income from 2 years ago. Here's where it gets tricky. If your income has decreased since then due to retirement, the death of a spouse, or other life-changing events, you can file an appeal to get those premiums reduced. But this appeal process has specific timeframes, and if you don't initiate it before the new year, you could be stuck paying inflated premiums for months while the appeal process is losing hundreds of dollars in the meantime. The second major issue involves the voluntary tax withholding elections that you can make on your Social Security benefits. A lot of people don't realize that Social Security benefits can be taxable depending on your combined income. And if you're not having taxes withheld from your monthly checks, you could face a massive tax bill come April. The IRS allows you to have federal taxes withheld from your Social Security at rates of 7, 10, 12, or 22%. If you need to adjust these withholdings or start having taxes taken out, you need to submit Form W-4V to the Social Security Administration. And here's the critical part. Changes made in December can take effect in January. But if you wait until January to make the change, you're looking at February or even March before it actually happens. That means months of undue withholding that you'll have to make up later, potentially pushing you into estimated tax payment territory with all the penalties and interest that comes with it. Now let's dig into something that affects people who are approaching their full retirement age or who are considering filing strategies. Social Security has what's called a monthly benefit calculation, and the month you file can actually impact your lifetime benefits in ways most people never consider. If you're born between the 2nd and 10th of the month, your benefits are paid on the 2nd Wednesday of each month. If you're born between the 11th and 20th, it's the third Wednesday. And if you're born after the 20th, it's the fourth Wednesday. But here's what matters for year end planning. If you're trying to maximize your benefits by filing at a specific time, understanding these payment schedules in relation to the calendar year is essential. Some people benefit from filing in December to get a payment before year end for tax planning purposes, while others are better off waiting until January to push income into the next tax year. This decision alone can shift thousands of dollars between tax years, affecting everything from your Medicare premiums 2 years later to your current year tax bracket. There's also the earnings test consideration that affects anyone who's receiving Social Security before their full retirement age and is still working. For 2024, if you're under full retirement age for the entire year, Social Security deducts $1 in benefits for every $2 you earn, above $22,320. If you reach full retirement age during 2025, the limit increases substantially, but only for the months before you reach that milestone. Here's the crucial planning point. Your earnings are counted on an annual basis. So, if you've been working and receiving benefits simultaneously, you need to calculate whether you're approaching that earnings limit before December 31st. If you are, you might be able to shift some income into January or adjust your work schedule to stay under the threshold and avoid having benefits withheld. Once benefits are withheld due to the earnings test, yes, you do eventually get them back after you reach full retirement age through an adjustment in your benefit amount. But in the meantime, you're dealing with reduced monthly income that could create cash flow problems. Let's talk about something that affects married couples specifically, the spousal benefit strategy and how year-end timing can impact it. If you're married and one spouse has significantly higher lifetime earnings than the other, the lower earning spouse may be entitled to a spousal benefit equal to up to 50% of the higher earner's full retirement age benefit amount. But here's the catch. To claim a spousal benefit, the primary worker must have already filed for their own benefits. Some couples delay this decision, but if there are financial reasons to have both spouses receiving benefits before year end, whether for income needs or tax planning, that filing needs to happen soon enough for the applications to be processed and the first payments to be issued. Social Security applications can take anywhere from a few days to several weeks to process, depending on how you file and whether there are any complications with your earnings record or other documentation. Another critical year-end consideration involves what's called a withdrawal of application or voluntary suspension of benefits. If you filed for Social Security early and now realize it was a mistake, you have exactly 12 months from your entitlement date to withdraw your application completely. You'll have to pay back everything you received, but then it's as if you never filed, and you can file again later at a higher benefit amount. That 12-month window is absolute. There are no extensions, no exceptions. If your deadline falls in December or early January, you need to act immediately. Similarly, once you reach full retirement age, you can voluntarily suspend your benefits to earn delayed retirement credits, which increase your benefit by 8% per year until age 70. Some people use this strategy after initially filing early, and the timing of when you initiate that suspension can impact how many months of delayed credits you accumulate before a specific age milestone. The representative payee situation is another area where year-end deadlines matter tremendously. If you're serving as a representative payee for someone else, maybe an aging parent or a disabled family member, you're required to file an annual accounting report with Social Security showing how you spent their benefits. These reports are typically due in January for the previous calendar year, but getting your documentation organized before the holiday rush is essential. The Social Security Administration takes these reports seriously, and if you're late or incomplete, they can remove you as payee, freeze the beneficiary's payments, or even pursue legal action if they suspect misuse of funds. It's not something to procrastinate on, especially if you're managing complex expenses or multiple beneficiaries. Then there's the issue of direct deposit and payment information updates. If you've changed banks, closed an account, or need to update your mailing address, doing this before year-end ensures your January payment arrives without interruption. It might sound simple, but Every year, thousands of people experience payment delays because they moved and didn't update their address, or their bank closed their account due to inactivity. When your Social Security payment gets returned to the Treasury, it triggers a whole process of verification before they'll reissue it. And that can take weeks or even months to resolve. The same goes for people who receive paper checks and are being pushed toward direct deposit. If Social Security has mandated that you switch to electronic payment, ignoring that deadline can result in suspended payments. For those of you who are receiving Social Security disability insurance, the continuing disability review is something you absolutely cannot ignore, especially if your review notice arrived recently. These reviews determine whether you still meet Social Security's definition of disability, and they happen periodically depending on your specific condition. If your review is due and you haven't responded to their requests for information, your benefits can be terminated, and reinstating them is a nightmare of appeals and documentation. Year end is a common time for these reviews to be scheduled, and with the holidays, it's easy to let paperwork slip through the cracks. Don't let that happen. Here's something else that catches people by surprise. The substantial gainful activity amount for disability beneficiaries increases almost every year for 2025. If you're working while receiving disability benefits, you need to know what the new threshold is, because earning even $1 over that amount in a month can trigger a review of your disability status. If you're close to that threshold, you might need to adjust your December work hours to stay under the limit. Or conversely, if you're planning to test your ability to return to work through the Ticket to Work program, starting that process at the right time in relation to the calendar year can maximize your trial work period benefits. The bottom line is this: Social Security isn't a set it and forget it system. It requires active management, especially at year end when multiple deadlines converge. The $2,400 we talked about at the beginning represents real money that real people lose every year simply because they didn't understand these rules or didn't act in time. You've spent your entire working life paying into this system, and you deserve every penny you're entitled to receive. Don't let bureaucratic deadlines or complex rules cost you benefits that are rightfully yours. The time to act is right now before that January 1st deadline closes the door on your options for this.